Most people don't feel nervous or fear around retirement because they don't have any money. They fear it because they have money and they don't know how to put it into income in an efficient way without fear of running out before you get to the end of the road. And that's a symptom of a deeper rooted problem. In the background, like the code of the Matrix, we have been indoctrinated by a system or a set of rules that have been marketed so heavily that we accept them almost as doctrine. But these rules were not set up for your benefit as the user. They were set up to help Wall Street financial institutions. And these rules work so heavily against you that if you don't actively take proactive steps against them, or at least be aware of them, you won't know until it's too late. Chances are you probably are already making mistakes right now that will cost you severely later in retirement unless we take some serious action against those rules to pull yourself out of the system and play by your own set. I'm Ryan Stone. I'm the Prosperity Professor, and I've helped dozens of Americans actually retire by understanding these rules and knowing how to take yourself out of it so that you can actually set up a game to win yourself. Today in this video, I'm going to go over 4 of the main rules that these financial institutions are playing by so that you're aware of them. And then this will help illuminate some of the biggest, mainly 2 or 3 of the biggest mistakes I see retirees making today so that you can be aware of them and take proactive steps today before you get into those situations later on. Let me be clear, this video is not meant to scare you. It's meant to help so that we can get ahead of things before problems become bigger. This video is really meant to give you clarity and the foresight that you deserve so that you can create predictable income. Understand that when healthcare costs arise, you're not on the hook for every cent. And knowing that you will have a seamless transfer of your legacy to your beneficiaries without probate coming in to step into play or without any other obstacles in your estate plan. I believe retirement should feel calmer than our working years, not louder and not more chaotic. The truth of the matter is, while there are a lot of people struggling right now, most people try their very best to do all the things they're taught to do. They spend decades working hard at their careers. They save money diligently. They invest into the accounts they're told to invest into, and they stay relatively disciplined. As soon as we hit retirement, these new questions come up. It's no longer, how do I grow my money? How do I get a higher rate of return? How do I make sure that my money is working for me while I'm working hard? Now the question is, how do I create predictable income from this? How do I insulate myself against volatility or investment risk? How do I insulate myself against healthcare costs? How do I make sure that if those healthcare costs come up, I'm not on the hook for things and have to deplete my portfolio value even more? These are the questions that most retirees really need to be asking themselves. The fact of the matter is, a good saver can still be a poor retiree if they try to play by Wall Street's rules. So, what are the 4 rules of Wall Street financial institutions? Rule number 1, institutions want control of capital. They want complete control of it, not just access. They want control over the deposits. They want control of the premiums. They want control over the contributions. They want assets under management so they can charge a fee on it. Where does this show up? Typically in the next few rules. Rule number 2 is they want habitual contributions over long periods of time. Keep saving in the market, keep investing. The market will always go up. Don't sell on a loss. They want you to keep putting in as often as possible so they're continuing to grow their AUM base and the fees that they can charge on it. This shows up when they engineer automatic deposits, payroll deductions, monthly premiums on things, set it and forget it investing, dollar cost averaging, or even putting in penalties for stopping contributions. And this brings us to rule number 3. Financial institutions want to hold on to our money for as long as possible. This is where rules and penalties and age restrictions show up. There's things like surrender charges or withdrawal penalties or requiring a certain holding period till a certain age or till a certain term of time has passed, or even lobbying for tax consequences for early withdrawal. Liquidity is discouraged when it comes to Wall Street vehicles because control is their goal. And then that brings us to the last step. Well, okay, we've saved our money into these investment vehicles. We've stockpiled as much as we can of our livelihoods. And now it comes time to retirement, or maybe before retirement, we need some access to funds. Unfortunately, those institutions will also play by this 4th rule. They want to give it back to us as slowly as possible and in the smallest amounts possible. This is the end game, right? They have required minimum distributions. They may ask for surrender fees even long after you're trying to take money out. Or they may posit and put lots of marketing dollars behind what's known as a safe withdrawal rate. So let's get this straight. You spent 40 years depositing large sums into these accounts. They spend 30 to 40 years trying to pay back as little as possible to you. Seem like a fair deal for you yet? Well, it gets worse because there's one more unspoken rule that they'll definitely not agree to, but is certainly seen to be the case. Financial institutions want you to believe that all this is normal, that putting money away into investment vehicles for long-term growth is the norm, and it's what everyone should be doing. You should take on risk. You should expect a 10-12% growth. But when it doesn't happen, you're the only one that has to risk it. You're the one that has to bring the bills home for your family. And the most ironic part is that even the financial institutions who tout these rules on us don't play by this game. But luckily for you, you've seen this video. So by the end of it, you'll be able to take yourself out of these rules as well if you just consider these questions and figure out options or solutions to get around these issues. The three biggest areas of concern that I would say for most retirees is creating income, predictable, safe, secure, making sure healthcare costs are covered, and making sure there's a seamless transfer of our estate to either our surviving spouse or the beneficiaries that we love and leave behind. So let's go with income first. One of the biggest mistakes I see retirees make is they confuse a portfolio balance with income possibilities. The fact of the matter is those Wall Street vehicles are great, typically, at growing our money over the course of our life. But because of those rules that financial institutions live and abide by, they are not great vehicles for creating predictable, stable income. Point in case, most stock-based financial advisors, most typical financial advisors think retirement income typically is solely based on what has been called a safe withdrawal rate. But I want to pause on that word safe for a moment. This safe withdrawal rate says, well, if the market continues to perform, and if you don't need more money than you're used to using on an annual basis, and if maybe you don't get sick suddenly and have a bump up in expenses, or if you don't live too long, then maybe with this safe withdrawal rate, your balance should last for a 25-year retirement. I don't know about you, but that's a lot of ifs to rely on. Safe is clearly just a rhetorical marketing word here that seems to be adopted almost as scripture or doctrine. But let me be clear, the safe withdrawal rate is not a contractual guarantee by any means. Most advisors reference this number to be around 4%. Morningstar came out with maybe 3.8 or 2.8, but historically, you can Google this, past 40, 50 years, it's been 4%. And it's been 4% because if you do the math on paper, it might last. Your money might last with that distribution rate, but might is not a certainty. Markets don't just send paychecks, they send volatility. And volatility matters far more in retirement than it ever did during your working life. See, a portfolio is a tool. It is not an income source. So let me show you why this matters in a quick example. Let me imagine two people, both are retiring with $1 million. The first person uses this 4% withdrawal rate, and that produces $1 million times 4%, $40,000 a year pre-tax, coming in every single year. Now, that income depends on the markets behaving well, as they should. They should probably continue to do the things that they normally do, which is go up and down. But it depends on timing, and that timing fluctuates, and you don't have a crystal ball on when that timing is going to occur in your favor or against it. Now, compare that with a properly structured income annuity that can pay 6 to 8% on distributions with a contractual guarantee. On that same $1 million, that's $60,000 to $80,000 a year in income, guaranteed contractual mailbox money coming in every single month. And that's not an opinion, it's math and contractual language. But there may be people watching this right now that because I said that big scary word annuity, they're already leering their head because the marketing of Wall Street is so good, it's got us indoctrinated that annuities are bad. The fact of the matter is the math doesn't lie. If you want safe income in retirement, you may have to break the rules of Wall Street institutions in order to secure the benefit you want in your life. After all, if you move some of your funds to an annuity so you get predictable retirement income coming in, Wall Street's not going to be able to charge an AUM fee on that money. But by doing so, you've now secured the principal, you've locked in a guaranteed distribution and payout rate, and you've insulated yourself from volatility. Let's take that example one step further. Let's say the very next year there's a 15% drop in the market. Well, person A's $1 million drops down $150,000. So now his 4% rule, his income coming out is also dropping. So that loss gets locked in. This is what many in the financial world would call sequence of returns risk. Now that volatility that's coming up in retirement plays such a bigger hand because you're taking active distributions out of the account and locking in those losses. So how do we play outside the rules that we just learned when it comes to our income? Well, when it comes to creating stable, guaranteed income, our goal shouldn't be about maximizing returns and taking on more risk in the market. Now it's all about creating predictability. We don't need maximum growth to create maximum income. We just need to think outside the rules of Wall Street financial institutions. To put a cap on this, I always tell my private members, buy the income you absolutely want coming into your personal economy month after month after month, and then take the rest and invest the difference. By doing so, you wipe the risk of running out of money, you wipe the risk of sequence of returns risk, you wipe the risk of taking too much out of your account on a monthly or annual basis completely off the table, because you've guaranteed the income that you need to sustain your lifestyle coming in, no ifs, ands, or buts. But that leads me to the next biggest mistake that retirees are faced with when they're playing by Wall Street's rules, and that is how to pay for healthcare costs as they rise up. Point of fact is, as we get older, we get sicker. Our bodies tend to not work as well. It's just the fact of life. And while everyone turns 65, you get to opt in for Medicare, Medicare doesn't cover all of the bills that come along with healthcare costs. And that's a huge mistake to not understand. One of the biggest terms that I see for retirees thinking about is long-term care. That is skilled nursing care, that's inpatient services or at your home service, skilled nursing care coming to your home. If you have a disabling event in retirement age, how do you want to be cared for? Well, if we don't have funds to pay for those extra healthcare costs, then it's going to be coming out of portfolios, or it's going to come out of selling our homes to increase liquidity. Here's some quick statistics about long-term care. First and foremost, there's a 63% chance that one person will have a long-term care event in their retirement age. There's a 94% chance that one person out of a couple will have a long-term care event in retirement. Typically, skilled nursing care can cost anywhere between $8,000 to $15,000 plus per month. So if we don't have funds earmarked for that specific purpose, then that means there's funds coming out of our portfolio. We're increasing the amount of distributions. We might be increasing those losses that we may have felt simply to pay for the care that we need in order to either get better or at the very least enjoy as much of our life as we can. But now that you know about this risk, here's some ways that we can get around it. Long-term care planning is really about preserving the dignity and preserving the choice that you have about the kind of care that you receive when those events come up. Now, depending on your age and where you're at, you can take care of this by either adding long-term care riders to permanent life insurance policies that pay out percentages of the death benefit or more if you have a long-term care event. Or you can even get long-term care riders attached to annuities that require far less underwriting, but then may either double or triple your principal for a period of time to help you take care of those long-term care costs. Or there's even income-based annuities that will double or triple your income for a period of time, maybe up to 5 years or more, depending on your long-term care need, to help offset those costs that you want in order to have the care that you want to receive. Look, there's a fact of the matter is we're either going to die early and sudden, or we're not, and we're going to live a long time, and either way our bodies will degrade and we're going to want care at that point in time. There's a wise man that once said, a healthy man has many desires in life, while a sick man only has one. And in that case, in a 10, 15, 20, 30 years, when you are sick and you want that care, I don't want you to be in a position where you have to choose between leaving the house inside the family or making sure there's funds for your spouse after you're gone, or you receiving the care that you want while you're still living. You should be able to do all of those things, and proper planning outside of Wall Street's rules can furnish that, but you have to take proactive steps now to get ahead of it. So up until this point, we've learned what those 4 rules that Wall Street financial institutions live by, and we've seen how to pull ourselves out of that for income, for our retirement, and for long-term care healthcare costs through retirement. But what happens after we're gone? What happens after, whatever you believe, God called us home and took us out of this world, and now we want to make sure what we left behind, what we lived and grew to build, is seamlessly passed on to either our surviving spouse or our kids or our grandkids, or maybe even a charity of your choice. We want the things that we build in life to go to whom we want, when we want, and it shouldn't be decided by a state judge. However, if you have not ever updated your estate plan, I'm sorry to say that's what's in your legacy's future. You see, without an updated estate plan, most people have the state estate plan, which is typically known as probate court. Probate court is long, arduous, costly process where your family is going to have to hire attorneys, pay lawyers and pay court fees and pay travel fees and maybe miss work for anywhere between 6 to 18 to 24 plus months to convince a state judge that your things should rightly go to your family. Well, what if you have a will? A will can be helpful, but in most states, a will have to be probated. You could write a will on a napkin, and as long as it's signed and notarized, it would be legitimate. But a will on its own has to go through probate court because the state needs to see, do you have other past relationships or spouses, or do you have outstanding debts with creditors or lenders, or do you have anyone that may have a claim to that estate? They need to pull everything, go into probate court, make it public to see before things are sent out to your beneficiaries. This is where proper estate planning and putting a trust into place can really change the game. The trust is the legalese or the walls that stand behind your will and what you want, and the state and probate court. Against what a lot of TikTokers might have you believe, a trust isn't necessarily about avoiding estate taxes. There's several different kinds of trust, but once you have one in place, make sure that you fund it correctly and make sure your trustees, your successive trustees, and your beneficiaries all know about the plan and have access to those documentations so that when that time comes and you do pass, there's a seamless transition of your benefits and things going to your beneficiaries and who you want to have them. Look, this was not a comprehensive synopsis. This was just a couple of ideas on how to get yourself out of the stress and chaos and rigmarole that Wall Street financial institutions want you to believe is completely normal. You do not have to play by those rules. There's a couple links down below that could help you if you want to connect and get further personal guidance on what might be right for you. But at the very least, I hope this video inspired you to think differently and think outside the box and really question whether those accounts that you have are going to furnish the income that you want, whether the different types of vehicles you set up have earmarked different amounts for you to cover long-term credit costs, and to make sure that your estate plan has a seamless transfer of your wealth to your beneficiaries after you're gone. Look, Wall Street is very good at its game at getting us to give them our money and to let them hold on to it for as long as possible. And as long as that's serving you, great, do it. But just look ahead and make sure that it will continue to serve you throughout every phase of your financial life. I'm Ryan Stone, the Prosperity Professor. Drop a comment below if you have any other questions about these specific topics, and be sure to follow more. I'll see you in the next video.